trading with the trend is probably one of the hardest things for a lot of traders to do, because normally when you have a trend day, a lot of traders tend to get chopped up. They tend to try to call the top. They tend to try to catch a falling knife. They tend to have stop losses that are too tight in consolidation, and the market keeps pushing in the favor that they assumed it was going to go in. So when there is a trend day and you can establish that there's a trend day, there's a couple of things that I do that I like to see in terms of a trend starting. So what I like to see is, are we over pre-market highs, right? Are we above those pre-market lows? When we do get a few pullbacks, are we staying over something of significance? What can that significance be? For me, it's going to be the 20 period moving average. So if we're still trading over the 20 period moving average, then for me, any pullback is nothing more than just a means for going higher. Any pullback is a means for going higher until we close below the 20 period moving average, which then you can see a downwards move. So if you are looking to stop getting chopped up when you are trading the trend, on these trend days, you need to take a couple of those things into consideration. Stop trying to be a hero. Stop trying to dictate when the market's going to stop going up. What you need to do is focus on just trying to stay with the trend as long as you can. Remember, the trend is your friend. You can even do things such as playing, flag breakouts, right? So even look at today's price action. Once we make this big, beautiful pop off the open, we have two little candles that are almost indecision type candles. What you can do is then put a trend line on top of that and play the breakout of the trend line. When you do get a significant pullback, like here, you get a nice pullback that kind of closes at the low of the previous candle range. What you can tell yourself is that if we break this downwards trend, maybe I can get in. If it closes back below, then you're going to have to get out of the trade. This was also another little nice trend break here. If you see multiple touch points here, pull back, pull back, pull back, pull back, pull back, pops right into this 20 period moving average. Nice little gain there. Pull back, pull back, pull back. Same deal here. You could also draw another trend line breakout here for another continuation pop. So anytime you're trading above the 20 period moving average, you want to stay on the same side as the trend. Now, the farther you get away from the original breakout, okay, so the original breakout is going to be here off the open. This is when we broke out over those pre-market and overnight highs. Once you get far away from that original breakout, you're going to want to cut your size down in half. So maybe after the first pop, you cut your size down 50%. And then maybe once you pull back the second time, you cut your size down 75%. And then if it's later on in the day going into lunchtime, maybe you get down to just about a quarter percent of your size. So what that would look like is, if you're trading one mini contract off the bell, maybe your next setup, which is going to be either 30-minute opening range or it's going to be an initial balance, maybe you're trading 5 micros, okay? 5 MNQs. And then if you're looking to play the next pullback, and you can see we've already been spending some extensive time above the original breakout, maybe you go down to 2 to 3 micros. And then if you have a 20 SMA play and you want to continue to play, maybe you play 1 or 2 micros. So again, all of these are going to call for different stop losses. All of these are going to call for different take profits, but it's going to be managing your risk. That's the sole thing here when it comes to trading, is managing that risk. Here, because we have a lot more volatility and a lot more range, I might want to throw on that one mini contract and catch 8, 12, 15, 20 points and then kind of build my day. As it pulls back, I'm not looking to take the trade on the same amount of position size, because if I lose, I'm not trying to give back everything that I made. So I might play on 5 micros and maybe risk half of what I made on my opening trade. If I continue and now I've won maybe 2 trades or maybe even 3 trades, what I want to do is get down into, about quarter size. So maybe something between 2 and 3 micros. That way, worst case scenario, even if I was risking something, something foolish like 50 points on the move, I'm going to lose $100, $150. And if I'm up $500, $600, it's not going to be no sweat off my back. And that's taking me into lunchtime. It's taking me after lunchtime. And then you can sort of make the decision to, hey, I took a few trades. A few of these trades worked out in my favor. I've been managing my position. I've been managing my money. And I've been scaling down. Now, the other thing that you can do is you can start opposite. You can start with very small size, and then you can increase your position size as you see price action a little bit more clear. So for some people, they find it tough to trade the big range off the open with bigger size. So what you can do is maybe start out looking for a little bit of a bigger move, but you're trading 1 or 2 micros. Maybe you're looking for 20 points. So it's $40 a contract, $80 total for a couple of contracts. And then as the day goes on and you see the trend start to develop, you can increase your size, go to 3 to 5 micros, and then maybe look for 10 to 15 points. And then as we get closer into lunchtime, maybe go up to 1 micro or 1 mini contract where you get a nice little setup to the long side in continuation with the trend on this 20 play. You take another $100 and you cap your day. There's 2 ways to do it. Both of these ways are very good, and both of these ways can manage your risk. But I'm not going to throw on 2 contracts here, 2 contracts here, 2 contracts here, 2 contracts here, because at any one given time, if any one of these particular setups along the day that you're trading fails, you're going to lose all of your gains, and you don't want to do that. Remember, manage your P&L against your position sizing. So earlier in the day, there's 2 ways to do it. You can go heavy, and if that first trade wins, now you can taper all the way back. That's kind of what I do. Or you can start small and kind of start to build your day very slowly by increasing the size as you see more candlesticks print. Whichever one is better for you is what you need to kind of focus on. If you can't handle the big range, I say start small and increase your size. If you like to catch that high volatility and you like to catch those opening drive plays and you like to catch trades within the first 30 minutes, then start heavy and then taper back. Okay, I hope this video helps you guys. Make sure to like, comment, subscribe. If you guys need those Apex accounts 90% off for the next 36 hours, I would say, use my link that's down in the description box below. You guys can use generic code SAVE NOW. Also, if you guys want to trade with me each and every single day live and you guys want access to the courses and the online live trading that we do on the conference call every morning, that link is also down in the description box as well. I'll catch you guys all next time.